Hello everyone. In this lecture video, I will be going over our topic for Class 2, Ethics and Professional Responsibilities. So for this video, I will be covering two sections. The first section will be looking at something called practitioners. So a practitioner is somebody who is authorized to appear before the IRS in the event of a dispute or disagreement over tax issues. A tax practitioner, underneath this definition, is specifically delineated through statute by the IRS, and there are rules that are specifically about who is authorized to practice before the IRS, what are the rules of conduct required of these persons, and what are the sanctions for violating such rules of conduct. In the second section, I will be going over another label given to financial professionals, which is a tax return preparer. This has its own separate definition according to the IRS, and subject to similar but different rules regarding their authorization to prepare tax returns. And I'll go over the definitions for both of these. And just keep in mind that these two labels given to the financial professionals may overlap, and so a tax practitioner may also be a tax return preparer, and likewise a tax return preparer can be a tax practitioner. So, what is a tax practitioner? When a dispute or disagreement over tax issues arise, a taxpayer may have to appear before the IRS. In this instance, there's specifically defined individuals that are authorized to practice before the IRS in representation of that taxpayer. So, certified public accountants or CPAs, enrolled agents or EAs, and attorneys are the primary groups of persons that the IRS authorizes to practice in representation of a taxpayer in front of the IRS. There are other categories of persons, and I'll go into more detail in the following slides. So all of the rules for this are listed in the Treasury Department Circular 230. So practice before the IRS is defined as presenting to the IRS or any of its officers or employees on any matter relating to a client's rights, privileges, or liabilities under laws or regulations administered by the IRS. So examples include representing a taxpayer when they're called into a conference or a meeting or a hearing with the IRS, preparing the necessary documents for them and filing them with the IRS, giving written advice, whether financial or legal, with respect to any entity, transaction, plan, or arrangement having a potential for tax avoidance or evasion, and generally corresponding and communicating with the IRS for a taxpayer. So, going into more detail, these are the persons authorized to practice. So, the first category is an attorney. So, an attorney who is a member in good standing of the bar of the highest court of any state, possession, territory, commonwealth, or the District of Columbia. Pretty self-explanatory. A certified public accountant or a CPA would be an individual qualified to practice as a CPA in any state, territory, or possession of the U.S. An enrolled agent is an individual who isn't an attorney or a CPA, but is otherwise eligible, qualified, and certified to represent a taxpayer. So the enrolled agent designation is issued by the IRS through the licensing scheme that the IRS administers, and individuals that pass that licensing exam can become enrolled agents. Then there's a catch-all category of practitioners, which are enrolled actuaries, enrolled retirement plan agents, and annual filing season program or AFSP participants. This is like specific jobs or roles that exist in the financial sector to help people in case they can't necessarily afford an attorney, a CPA, or an enrolled agent. And sometimes, depending on the tax issue that's the basis of actually the reason why the taxpayer is even called in, may change, and maybe a taxpayer would elect to use a enrolled retirement plan agent, let's say, if the tax issue is regarding their retirement account. So important to note is that in order to practice before the IRS, an attorney or a CPA cannot be suspended or disbarred, and they must file a written declaration to the IRS for each party that he or she is representing. So in the written declaration, they essentially would pretty much swear an oath, let's say, in a written form that they're qualified and they're authorized by the party to represent that party. So why is it that an attorney or a CPA must have this written declaration in order to practice before the IRS? Well, I have here a chart that lays out the differences between attorneys, CPAs, and EAs as compared to AFSP participants who are not attorneys, CPAs, or EAs. As you can see, in the first category, all three of these types of practitioners, attorneys, CPAs, and EAs, go through a regimented licensing scheme in order to be qualified to become a tax practitioner and represent a taxpayer in front of the IRS. They have an unlimited scope of practice, and they essentially can represent a taxpayer before anyone at the IRS and have the ability to prepare returns or file claims for refunds, pretty much any type. And you see that on the right side, for all non-attorneys, non-CPAs, and non-EAs, there's a limited scope of representation for these people, and they can only appear before IRS revenue agents, customer service representatives, and employees. And they can only do so during an actual examination in front of the IRS, and they can only represent the taxpayer for the tax return that the taxpayer signed for the period under examination. This is different from the attorneys, CPAs, and EAs that can represent a taxpayer on older returns or older claims for refund. And the last difference is that the attorneys, CPAs, and EAs have an unlimited scope when it comes to tax planning and giving tax advice, whereas the AFSP participants are limited to simply preparing a tax return or preparing a claim for refund. So, there are 9 elements or rules of conduct that practitioners have to adhere to while they are providing financial and professional advice and services for a taxpayer. And these apply when the practitioner is also fulfilling the function of a tax preparer. And these are the 9 listed here, and I'll be going the first 4 in more detail. So, the first rule of conduct for practitioners that practitioners may not violate is a conflict of interest. So, a conflict of interest may exist in two situations. The first is a directly adverse conflict, and the second situation is a materially limited conflict. So, a directly adverse conflict refers to when a CPA is representing one person in a federal tax matter, and also they represent a person who may actually come in and argue before the IRS that something that is detrimental to the first party that the practitioner is representing. So, to put it another way, an example could be where there are spouses, so a married couple, who are both jointly liable with respect to a tax liability. So the IRS is essentially suing a married couple for, let's say, not paying taxes. So one spouse may have in that hearing defenses that, if heard, would come to the detriment of the other spouse. An example of this would be the innocent spouse defense, where one spouse says, "Oh, I had no idea that my partner didn't pay the taxes at all." And if the CPA were to represent both spouses in this situation, then he would be in violation of this first part of a conflict of interest, because the interests of either spouse would be directly adverse to each other and therefore in a conflict. And consent can't actually be obtained in that situation either. For the second situation that is defined as a conflict of interest, which is the material limitation conflict of interest, this means that even if there's no directly adverse relationship, a conflict of interest may still exist if there's a significant risk that the CPA's ability to consider, recommend, or carry on an appropriate course of action for their client will be materially limited as a result of the CPA's other responsibilities or interests. An example would be if a CPA is asked to provide federal tax services to multiple people at the same time, and these people together want to form a joint venture or like a new company together. The CPA's ability to recommend or advocate all the possible positions that each client might take would be materially limited because of the CPA's relationship and loyalty to the other people that are also seeking to form a joint venture. So in this situation, the CPA would be materially limited because of his or her relationship and loyalty to the other individuals seeking to form this new business, and that would impair his or her integrity and objectivity. So a practitioner may represent conflicting interests before the IRS only if three criterias are fulfilled. The first would be to provide informed and written consent to all directly affected parties. And this would be done once the practitioner gains the knowledge of the existence of the conflict, and then this written consent must be within 30 days of informed consent. Secondly, the representation cannot be prohibited by any law. And thirdly, the practitioner must reasonably believe that he or she can provide competent and diligent representation to each client. And just a note, a practitioner is not required to disclose the conflict of interest to the IRS.